want to bring in Mainstay Capital's David Kudla right now. Talk about the quarter. David, good to see you.
Good morning.
Thank you so much for joining us. John Hilsenrath also joining us this morning with the Fed and economics part of this story. We'll get to John momentarily. David, how was the quarter? Does this quarter tell you anything about what's ahead for the year?
I think that what's interesting is where we've come from. The big sell-off at the beginning of the year, we had all the forecasts
about panic,
about a bear market, about a recession. Now we've rallied back 12%. The bears have gone back into hibernation. Nobody's talking, well, not talking about as much about a recession. And now a lot of forecasters are coming back with higher numbers through the end of the year. We think we're still in a trading range. We've been in this trading range for 2 years, between 1810 and 2135 for the S&P 500. We can have the debate about bear or bull. Are we at a bear market or bull market? We think we're just in this trading range, and we're now towards the higher end of that trading range. So I think investors in the second quarter need to be prepared that we could have another downstroke in the second quarter.
So you're selling into things right here?
Well, I think it's a matter of what you hold, what you do in your portfolio as an investor. And that brings us to looking at defensive issues that hold up well in market downturns. Dividend payers, we really like right now for 2 reasons. One, yields are so low. Negative yields around the world, low yields here. So we get a dividend yield with stocks that can do more for us than holding bonds right now. And that dividend yield provides a floor in terms of total return, and they hold up better in downturns. It
is true, Michael, that the backdrop in terms of recession fears have faded.
They've faded, and yet we're seeing some of these Q1 figures coming out. That personal spending downward revision the other day was a disaster. And you saw the Atlanta Fed's GP tracking estimate go to 0.6%. So not quite a recession, but definitely stuck in the mud. So, with that, David, I mean, so you like the income-producing stocks. I saw preferred stocks, something that you like a lot. So I assume you like value over growth here in terms of more defensive play?
Right, more of a value orientation this year. And on those numbers, what do we have? We have this battle between fundamentals and the Fed and central banks around the world. There was a lot this quarter. Janet Yellen this week, central bank in Europe earlier, that buoyed stocks. And we get into earnings season, start to look at fundamentals again, some of the numbers you talked about. I think there will be some concern come back into the market.
Corporate profits were down 11.4% in Q4. That was part of the GDP print. Do we think it's going to be better with some of this data we're seeing? I don't think so.
You said the other day it's going to be down 9%. First quarter earnings.
First quarter earnings are looking disastrous.
First quarter earnings down 8 to 9%. We're on track for the worst string of negative quarterly earnings since the financial crisis.
What's hilarious is with stocks higher, the bull case here is now, well, eventually we're going to lap those bad earnings, meaning the comparison is going to be easier. So that's bullish. No, thank you.
You know what, Dagan, the other day, one of the big trading desks, one of the guys on the desk said to me, the stocks that you want to own are down the most for no good reason. And the reason is because hedge funds have been forced to sell them.
Right.
So they're liquidating because the hedge funds community is under such pressure. And that's pressuring stocks that in ordinary times you would want to own because they've got the earnings growth. And the stocks they don't want to own, which are way overvalued, are actually continuing to be overvalued.
Right. To your point about these defensive names, food companies, they look really crowded. Because I've heard this repeatedly from individuals who are concerned about the market, maybe concerned about the economy. McDonald's yesterday, Coca-Cola, J&J hitting record highs. A lot of the food stocks at record highs here. I mean, at what point do you say, hey, this value stock has an unattractive valuation on it?
Right. And we've seen this become, a more crowded trade, but for a reason. For a reason. You could almost make the case that these are the new momentum stocks because they're so attractive in this environment. And valuations are high, but I think it's still an attractive sector.
Let me bring John Hilsenrath in from the Wall Street Journal. And, John, we heard Janet Yellen speak this week as well. Did that play into anything? It certainly rallied stocks, her commentary on greater gradualism in terms of raising interest rates, right?
Well, I certainly think it did. One of the fundamentals of valuation is the discount rate. How do you discount future cash flows? And not only Yellen, but what central banks are saying all over the world is that interest rates are going to stay very low for a very long time, not just for the next year, but for years into the future. And that makes the value of future cash flows greater, and that's why stocks are rising.
John, it's Mike Block. Hey, is 2016 effectively off the table now, given what Yellen said? We had some hawkish talk between the statement and her speech at the Economic Club the other day, and that's all been blown out of the water by how dovish she was. I mean, is 2016 off the table now?
No, I think we ought to take as their benchmark the 2 rate increases that they penciled in their dot plot in their forecast for the year. You know, I'm looking at June as a month when they might go, but you know, it's going to, as she always says, it's going to come down to whether the data hold up over the next few months. The inflation numbers are showing signs of a little bit of lift, but she wants to see that's sustained. She's suspicious that it might not be sustained.
It's interesting that you would say that. Is 2016 completely off the table after the speech? Do you buy into that as well? I mean, when you see what she said the other day, because it's true. She was a lot more dovish, meaning, you know, she wants no rate hikes.
Some people thought that if you thought she was more dovish, that people misread the statement from earlier in the month.
The dot plot went from 4 to 2. They're at 2 now.
Dot plot meaning the times that they're going to raise interest rates on the calendar.
Right. Okay. The forecast from all the Fed members, but we're looking at 1 hike this year, and that's it.
1 hike. You think it's June or after the election?
June, or they'll wait till after the election, but 1 hike.
I think we're glossing over that. She effectively put QE4 back on the table. I know I'm rolling a grenade into the room, but she did. She really did. It's right there in the text.
Is that what you agree with that, Hilsenrath?
Well, you know, I don't see them doing QE4. Let's look at the unemployment numbers tomorrow. You know, we're under 5%. Unemployment is falling all over the world. I realize that there are a lot of fuzzy things about those numbers, but I don't see how they launch another QE program in an environment where unemployment is continuing to fall and the inflation numbers are showing a little bit of lift. That doesn't happen unless we're back in the sink, unless the economy is slowing and possibly going into a recession.
All right, we'll watch the numbers tomorrow. But, you know, 205,000 new jobs created in the last month. Not great. It's just basically what we've been seeing, right, John?
It's what we've been seeing, and that was enough to get them to move in December. They don't want to move quickly, but if we continue to see improvement, then, you know, they move in a very tiny, gradual fashion, like they say.
For sure. And that's what she said the other day. David Kudla, always good to see you.
Thank you.
Thanks so much. John Hilsenrath, we'll see you soon, sir. Thank you very much.
Thank you.